Let me tell you something that is going to upset a lot of financial advisors. The standard advice you have been given about your 401k allocation is wrong. Not slightly off, not in need of minor adjustments. Fundamentally, dangerously wrong. And if you follow that conventional wisdom, you are setting yourself up for a retirement that is far less comfortable than it should be. I have spent over 4 decades managing money for some of the wealthiest individuals and institutions in the world. I have seen bull markets and bear markets. I have seen bubbles inflate and collapse. I have made billions of dollars by understanding how markets actually work, not how textbooks say they should work. And I am telling you right now that the allocation strategy most Americans are using in their 401k accounts is based on outdated assumptions, flawed logic, and a fundamental misunderstanding of risk. Today, I am going to show you exactly what is wrong with your 401k allocation and what you should do about it. This is not advice I would normally give publicly, but I have watched too many hardworking people approach retirement with portfolios that are completely misaligned with their actual goals. And it bothers me. It keeps me up at night. So I am going to tell you the truth, even if it contradicts everything you have been told. Let me start with the biggest lie in retirement planning: the target date fund. If you are like most Americans with a 401k, you have probably been told to invest in a target date fund. Pick the fund with the year closest to when you plan to retire, and the fund will automatically adjust your allocation over time. It sounds simple. It sounds smart. It sounds like you do not have to think about it. That is exactly the problem. Target date funds are designed to be easy, not optimal. They are designed to prevent lawsuits against plan sponsors, not to maximize your retirement wealth. They follow a one-size-fits-all approach that ignores everything, that makes your situation unique. Here is how target date funds work. When you are young, they put most of your money in stocks. As you get older, they gradually shift to bonds. By the time you retire, you might have 40 or 50% of your portfolio in bonds. The theory is that you cannot afford volatility as you approach retirement, so you need to reduce risk by owning more bonds. This theory made sense in the 1980s when bonds yielded 10 or 12%. If you could get a guaranteed 10% return from bonds, why take the risk of stocks? But we do not live in the 1980s anymore. Bond yields are dramatically lower, and the advice that made sense 40 years ago is now actively harmful. Let me show you the math that target date fund managers do not want you to see. A 60-year-old today has a life expectancy of approximately another 25 years. Some will live longer, some shorter. But on average, a 60-year-old will live to about 85. And if they are married, there is a good chance at least one spouse will live past 90. That means a 60-year-old retiree needs their portfolio to last 25 to 30 years, maybe longer. That is not a short time horizon. That is a very long time horizon. And over long time horizons, stocks have dramatically outperformed bonds throughout all of recorded financial history. But what does a target date fund do to a 60-year-old? It puts 40 to 50% of their money in bonds yielding 3 or 4%. After inflation, those bonds might yield 1%, maybe 0, maybe negative in real terms. Half of the retiree's portfolio is earning essentially nothing in real terms. Meanwhile, stocks have historically returned about 7% after inflation over long periods. 7% real returns versus 0% real returns over 25 years. That difference is enormous. A portfolio that earns 7% real doubles in about 10 years and quadruples in about 20 years. A portfolio that earns 0% real stays flat. It does not grow at all. This is the hidden cost of the conventional 401k allocation. By shifting too much to bonds too early, you are dramatically reducing your long-term wealth. You are sacrificing decades of compounding for the illusion of safety. And it is an illusion, because bonds have their own risks that most investors do not understand. Let me explain the risks of bonds that your financial advisor is not telling you about. The first risk is inflation. Bonds pay a fixed amount of interest. If inflation rises, the purchasing power of that interest declines. And if inflation rises significantly, like it did in 2021 and 2022, bond prices can collapse. The supposedly safe part of your portfolio can lose 20% or more in a single year. That is exactly what happened in 2022. Bonds had their worst year in over 200 years of recorded history. The safe asset was not safe at all. The second risk is interest rate risk. When interest rates rise, bond prices fall. This is basic bond math. And we are in an environment where interest rates could rise further. The federal government is running massive deficits. The debt is exploding. At some point, bond investors might demand higher yields to compensate for the risk of lending to an increasingly indebted government. If that happens, bond prices will fall, and the supposedly safe part of your portfolio will decline. The third risk is opportunity cost. Every dollar you have in bonds is a dollar that is not compounding at the higher rates available in stocks. Over short periods, this does not matter much. Over 20 or 30 years, it matters enormously. The opportunity cost of holding bonds in a retirement portfolio is measured in hundreds of thousands of dollars of foregone wealth. I am not saying bonds have no place in a portfolio. They do. They provide stability and income. They can be useful for short-term needs. But the conventional wisdom that you should have 40 or 50% of your portfolio in bonds by the time you retire is, in my view, a recipe for running out of money. Now let me tell you the second major problem with your 401k allocation. Over-diversification. Diversification is good. Owning stocks across different sectors and geographies reduces risk without reducing expected returns. This is one of the few free lunches in investing. But there is a difference between smart diversification and mindless over-diversification. And most 401k investors have crossed the line into mindless over-diversification. Here is what I mean. A typical 401k investor might own a U.S. large cap fund, a U.S. small cap fund, an international developed fund, an international emerging markets fund, a bond fund, maybe a REIT fund. They think they are being prudent by spreading their money across all these asset classes. But look at what actually happens. The U.S. large cap fund is dominated by maybe 50 stocks that determine most of its returns. The U.S. small cap fund adds a lot of stocks, but small caps represent a small portion of total market value. International developed markets are highly correlated with U.S. markets. They go up and down together. International emerging markets add some diversification, but also add a lot of risk from currency, politics, and governance issues. After all this supposed diversification, the investor ends up with a portfolio that moves almost exactly like the U.S. stock market, but with higher fees, more complexity, and lower expected returns from the international allocations. This is diversification theater. It looks like you are doing something sophisticated. It looks like you are managing risk. But in reality, you are just adding complexity and costs without meaningful benefit. Here is what I would do instead. I would concentrate my equity allocation in high-quality U.S. large-cap stocks. These are the companies that dominate the global economy. Apple, Microsoft, Amazon, Google, Johnson & Johnson, Procter & Gamble. These companies earn revenue all over the world. They are already globally diversified at the company level. You do not need to own a separate international fund to get international exposure. You get it automatically by owning the best American companies. By concentrating in high-quality U.S. large caps, you get exposure to the strongest companies in the world with the best governance, the deepest capital markets, and the longest track record of creating shareholder value. Why would you dilute that with lower-quality international companies just for the sake of diversification? The data supports this approach. Over the past 15 years, U.S. stocks have dramatically outperformed international stocks. This is not a random fluctuation. It reflects the fundamental superiority of American companies and American capital markets. The U.S. has the best technology companies, the most innovative business culture, the deepest pools of capital, and the strongest rule of law. These advantages are not going away. Now, let me address the third major problem with your 401k allocation. The glide path is backwards. Remember how target date funds work. They start aggressive when you are young and get conservative as you age. The idea is that you have more time to recover from losses when you are young, so you can afford to take more risk. As you age and approach retirement, you have less time to recover, so you should take less risk. This logic seems intuitive, but it is actually backwards when you think about it carefully. When you are young, your 401k balance is small relative to your future contributions. If you are 25 years old with $10,000 in your 401k and you contribute $10,000 per year, your future contributions are far more valuable than your current balance. Whether the market goes up or down this year matters much less than whether you keep contributing. But when you are 60 with $1 million in your 401k and only 5 more years of contributions, your current balance is far more valuable than your future contributions. The returns on that $1 million will determine your retirement lifestyle far more than the $50,000 you contribute over the next 5 years. Here is where the logic gets interesting. When your balance is small, portfolio volatility does not matter much because contributions dominate. When your balance is large, portfolio volatility matters enormously because returns dominate. But target date funds do the opposite of what this logic suggests. They take maximum risk when your balance is small and volatility does not matter. They take minimum risk when your balance is large and you actually need the returns. A better approach would be to start conservative when you are young and get more aggressive as you age. I know this sounds crazy. It contradicts everything you have been told. But think about it. When you are 25, your 401k balance is trivial. Whether it returns 5% or 15% this year, the difference is a few $100s. Not life-changing, but if you lose your job in a recession, having a stable portfolio means you do not have to sell at the bottom to cover expenses. When you are 55, your 401k balance is substantial. The difference between 5% and 15% returns is tens of thousands of dollars per year. That is life-changing. That is the difference between a comfortable retirement and a constrained one. You need those returns, and you have enough wealth that you can ride out volatility. You are not going to panic sell because you have decades of investing experience. I am not saying you should be 100% in stocks at age 65, but I am saying that the conventional glide path, which has you at 50% bonds by retirement, is too conservative for most people. A 70-30 or even 80-20 stock to bond allocation might be more appropriate for retirees who have other sources of income, who can tolerate volatility, and who need their portfolio to last 25 to 30 years. Let me tell you the fourth major problem with your 401k allocation. You are not taking advantage of employer matching. This is the easiest money you will ever make, and an astonishing number of people leave it on the table. Most employers that offer 401k plans also offer some kind of matching contribution. A common formula is 50 cents on the dollar up to 6% of your salary. That means if you earn $100,000 and contribute $6,000 to your 401k, your employer adds another $3,000. That is a 50% return on your money instantly before any market returns. There is no investment in the world that offers a guaranteed 50% return. None. This is free money. It is the closest thing to a financial miracle that exists. And yet surveys show that about 20% of employees do not contribute enough to get the full match. They are literally turning down free money. If your employer offers matching, your first priority should be contributing enough to get the full match before you pay down debt, before you save in a taxable account, before you do anything else with your money. Get the full match. This is not even close to a difficult decision. And here is something else most people do not realize. The employer match does not count toward your annual contribution limit in 2024. You can contribute $23,000 of your own money to a 401k. If your employer matches $3,000, your total contribution is $26,000. The match is on top of your limit, not part of it. Over a career, employer matching can add hundreds of thousands of dollars to your retirement savings. This is not a small detail. This is one of the most important factors in determining your retirement wealth, and it has nothing to do with investment returns or asset allocation. It is just about capturing free money that your employer is willing to give you. Now, let me give you my actual recommendations for how to fix your 401k allocation. These are not generic suggestions. These are specific actions I would take if I were managing my own 401k first. Reduce your bond allocation if you are more than 10 years from retirement. You probably should not own any bonds at all. Your time horizon is long enough that you can ride out any volatility. You need the higher returns that stocks provide. Every dollar in bonds is a dollar not compounding at equity rates. If you are within 10 years of retirement, you might want some bonds for stability, but probably not as much as the target date fund suggests. 20% bonds is probably enough for most people, 30% at most. The conventional 50% bond allocation at retirement is far too conservative for anyone who needs their money to last 25 years or more. Second, simplify your equity allocation. You do not need 5 different equity funds. You probably do not need international funds at all, since large U.S. companies already give you global exposure. A single U.S. large cap index fund, like an S&P 500 fund, is sufficient for most people. It is diversified across 500 companies and dozens of industries. It has the lowest fees. It captures the returns of the best companies in the world. If you want to get slightly more sophisticated, you could add a small allocation to a U.S. small cap value fund. Small cap value stocks have historically outperformed large caps over very long periods, though they are more volatile. A 90-10 or 80-20 split between large caps and small cap value is reasonable. Third, maximize your contributions, especially if you are getting employer matching. At minimum, contribute enough to get the full match. That is free money. If you can afford to contribute more, do it. The tax advantages of 401k contributions are substantial. Money you put in reduces your current tax bill and grows tax-free until retirement. There is no other vehicle that offers these combined benefits. If you are over 50, you can make catch-up contributions of an additional $7,500 per year. Take advantage of this. You have fewer years until retirement, so you need to save more aggressively. Fourth, check your fees. 401k plans vary enormously in the fees they charge. Some plans offer low-cost index funds with expense ratios of 0.03%. Others offer expensive actively managed funds with expense ratios of 1% or more. Over a career, that fee difference can cost you hundreds of thousands of dollars. If your plan offers low-cost index funds, use them. If it does not, complain to your HR department. Lobby for better options. If the fees are egregious, consider contributing only enough to get the match and then saving additional money in an IRA where you control the investment options. Fifth, do not panic during downturns. This is perhaps the most important advice I can give. Your 401k is a long-term investment. It is going to go through multiple bear markets before you retire. When those bear markets happen, the worst thing you can do is sell. I have seen so many people destroy their retirement savings by selling during market crashes. They see their balance down 30 or 40%. They panic. They move everything to cash or bonds. Then the market recovers, and they are sitting in cash, missing the recovery. They buy back in after stocks have already rebounded. They lock in their losses and miss the gains. Do not be one of these people. When the market crashes, keep contributing. Keep your allocation steady. Actually consider increasing your contributions if you can afford it. You are buying stocks on sale. This is when the long-term returns are made, not during the euphoric bull markets. Let me also talk about some special situations that might apply to you. If you are in your 20s or 30s, be aggressive. You have decades until retirement. You can afford to be 100% in stocks. The volatility will not matter over 30 or 40 years. What will matter is capturing the long-term returns of equities. Every year you spend in bonds at this age is a year of compounding you will never get back. If you are in your 40s or 50s, you can start thinking about adding some stability to your portfolio. But do not go overboard. 20% bonds is plenty. You still have a long time horizon. You still need growth. Do not let fear drive you into an overly conservative allocation that will leave you short in retirement. If you are in your 60s approaching retirement, resist the urge to get too conservative. Yes, you want some stability. Yes, you do not want to retire into a bear market with no cushion. but you also need your portfolio to last 25 years or more. An excessively conservative allocation will run out of money. 30% bonds is probably enough for most people. Keep the rest in high-quality stocks that can grow over the decades of retirement ahead of you. If you have a pension or substantial Social Security, you can afford to be more aggressive with your 401k. The pension and Social Security provide a floor of guaranteed income. Your 401k can take more risk because you are not depending on it for every dollar of retirement spending. In this case, you might be comfortable with 90% or even 100% stocks, since your downside is protected by other income sources. If you are planning to work part-time in retirement, you can also be more aggressive. Work income provides a cushion that allows your portfolio to recover from any downturns. You do not have to sell stocks when they are down because you have income coming in. This changes the math significantly and allows for a more growth-oriented allocation. Let me close with a broader point about why conventional 401k advice is so wrong. The financial planning industry is designed to minimize lawsuits, not maximize client wealth. Target date funds exist because they are defensible. If a client complains that their returns were too low, the advisor can say they were following industry standard practices. If a client loses money in a crash, the advisor can say they were appropriately diversified. The goal is to avoid blame, not to generate optimal results. This is not a conspiracy. It is just how institutions work. The people giving you advice have their own incentives, and those incentives are not perfectly aligned with yours. They want to keep their jobs and avoid being sued. You want to maximize your retirement wealth. These are not the same thing. That is why you have to take responsibility for your own allocation. Do not just default into a target date fund and forget about it. Do not just follow whatever advice your HR department provides. Think critically about your own situation. Consider your time horizon, your risk tolerance, your other sources of income, your goals. Then make an allocation decision that is right for you, not one that is designed to protect someone else from liability. The standard advice is wrong. The target date fund glide path is wrong. The over-diversification is wrong. The excessive bond allocation is wrong. I have told you what I think is right. Now it is up to you to act on it. Your retirement is too important to leave to default settings and conventional wisdom. Take control, fix your allocation, and give yourself the best possible chance at the retirement you deserve. Because the difference between getting this right and getting it wrong is not small. It is not a few percentage points. It is potentially hundreds of thousands of dollars. It is the difference between a comfortable retirement and a constrained one. It is the difference between leaving a legacy to your children and depending on them for support. The stakes are that high. And the conventional wisdom is that wrong. Do not let flawed advice determine your financial future. Take what I have told you today and make changes. Your future self will thank you. Now let me go deeper on some specific mistakes I see people making in their 401k accounts, because understanding these mistakes will help you avoid them. The first common mistake is chasing past performance. Every year, your 401k plan probably shows you which funds perform best over the past 1, 3, and 5 years. And every year, people pile into whatever fund had the best returns. This is exactly backwards. Here is the dirty secret of investing. Past performance does not predict future performance. In fact, it often predicts the opposite. Funds that have outperformed recently tend to be concentrated in whatever sector or style has been hot. When that sector or style inevitably cools off, the fund underperforms. Meanwhile, the funds that have underperformed are often concentrated in out-of-favor areas that are poised to rebound. I have watched this cycle play out dozens of times. In the late 1990s, everyone piled into technology funds because they had the best returns. Then the dot-com crash happened, and those funds lost 80%. In the mid-2000s, everyone piled into real estate and financial funds because they had the best returns. Then the financial crisis happened, and those funds collapsed. In recent years, everyone has piled into growth stocks because they have had the best returns, and growth stocks got crushed in 2022. The pattern is always the same. Investors buy high and sell low because they chase past performance. They buy whatever has already gone up and sell whatever has already gone down. This is the exact opposite of what you should do, instead of chasing performance. Stick with a simple, diversified allocation and rebalance regularly. When stocks go up and become a larger portion of your portfolio, sell some stocks and buy bonds to get back to your target. When stocks go down and become a smaller portion, sell some bonds and buy stocks. This forces you to buy low and sell high, which is how you actually make money over time. The second common mistake is checking your balance too often. This might sound strange. How can looking at your account be a mistake? But the research is clear. Investors who check their portfolios frequently make worse decisions than investors who check infrequently. Here is why. When you check your balance daily or weekly, you experience every little fluctuation. You see your balance down 2% and you feel pain. You see it down 5% and you panic. You start thinking about selling, about protecting yourself, about avoiding further losses. And sometimes you act on those feelings and make changes that hurt your long-term returns. But if you check your balance quarterly or annually, you do not experience those daily fluctuations. You see the big picture, and over quarters and years, the big picture for a diversified stock portfolio is almost always up. You feel good about your progress. You stay invested. You do not make panic decisions. I know it is hard not to look. We live in an age of constant information. Your balance is available on your phone 24 hours a day. But try to resist the urge. Set a schedule for checking your 401k. Once a quarter is plenty, once a year is even better. Let your money compound without the emotional interference of watching every wiggle. The third common mistake is taking loans from your 401k. Many plans allow you to borrow from your own account for things like home purchases or financial emergencies. This sounds harmless. You are borrowing from yourself. After all, you pay the interest back to yourself. What is the problem? The problem is opportunity cost. When you take a loan from your 401k, that money is no longer invested in the market. It is sitting in cash, earning whatever interest rate you are paying yourself, which is typically much lower than what stocks would return. Every day that money is out of the market is a day of compounding you will never get back. There is also the repayment risk. If you leave your job, voluntarily or involuntarily, most plans require you to repay the loan immediately. If you cannot repay, the loan is treated as a distribution. You pay income taxes plus a 10% penalty if you are under 59.5. What seemed like a harmless loan becomes an expensive withdrawal. I have seen people take 401k loans to buy cars, to take vacations, to pay for weddings. These are terrible uses of retirement savings. You are sacrificing decades of future compounding for something you want today. If you cannot afford it without raiding your retirement account, you cannot afford it. Period. The fourth common mistake is not increasing contributions when you get a raise. This is a subtle one, but it makes an enormous difference over time. Let us say you are contributing 10% of your salary to your 401k. You get a 5% raise. Your lifestyle adjusts upward. You spend a little more on restaurants, maybe a nicer car, a better apartment. Your 401k contribution stays at 10% of your salary. So it goes up a little, but most of the raise goes to increased spending. Now imagine an alternative. You get a 5% raise and you increase your 401k contribution to 11 or 12%. You still get some lifestyle improvement, but a significant portion of the raise goes to retirement savings. Your 401k balance grows faster, and because you never experience that extra spending, you do not miss it. If you do this every time you get a raise, your contribution rate gradually increases over your career. By the time you are in your peak earning years, you might be contributing 15 or 20% of your salary. That is how you build serious retirement wealth. Not by contributing a fixed percentage forever, but by ratcheting up your savings rate as your income grows. The fifth common mistake is ignoring the Roth option. Many 401k plans now offer a Roth option, in addition to the traditional option. With a traditional 401k, you contribute pre-tax dollars and pay taxes when you withdraw in retirement. With a Roth 401k, you contribute after-tax dollars, but pay no taxes on withdrawals in retirement. Which is better depends on your situation, but most people should at least consider the Roth option, especially if you are young and in a lower tax bracket than you will be in retirement. Think about it this way. If you are 25 years old and earning $50,000, you might be in the 12% tax bracket. If you contribute to a traditional 401k, you save 12 cents in taxes for every dollar you contribute. But when you withdraw in retirement, you might be in a higher bracket because you have built wealth, because tax rates might have increased because of required minimum distributions pushing up your income. You might pay 20 or 25% on every dollar you withdraw. By using the Roth option, you pay the 12% tax now and never pay taxes again. The growth, which will be the vast majority of your account after 40 years of compounding, is completely tax-free. This can save you hundreds of thousands of dollars over your lifetime. If you are in your peak earning years and in a high tax bracket, the traditional option might make more sense. But even then, having some Roth money provides flexibility in retirement. You can manage your taxable income by drawing from traditional accounts up to a certain level and then switching to Roth accounts. This kind of tax planning can reduce your lifetime tax burden significantly. The sixth common mistake is ignoring your asset location. This is an advanced concept, but it can make a real difference in your after-tax returns. Different types of investments are taxed differently. Stocks held for more than a year generate long-term capital gains, which are taxed at preferential rates. Bonds generate interest, which is taxed as ordinary income. REITs generate dividends that are often taxed as ordinary income. If you have both tax-advantaged accounts like 401ks and IRAs and taxable brokerage accounts, you should think about which investments go where. In general, you want to put your least tax-efficient investments in your tax-advantaged accounts, bonds, REITs, actively managed funds that generate lots of short-term gains. These belong in your 401k where the income is sheltered. Stocks, especially those you plan to hold for the long term, can go in taxable accounts where you benefit from the lower capital gains rates. This is called asset location, and it can add 0.5% or more to your after-tax returns annually over decades. That adds up to real money, but most people never think about it. They just split their allocation evenly across all accounts, paying more taxes than necessary. Let me also address a question I get all the time. What about rolling over old 401ks? When you leave a job, you have several options for your 401k. You can leave it with your old employer. You can roll it into your new employer's plan. You can roll it into an IRA. Or you can cash it out, which is almost always a terrible idea because of taxes and penalties. In most cases, I recommend rolling old 401ks into an IRA. An IRA gives you complete control over your investment options. You are not limited to whatever funds your employer selected. You can choose low-cost index funds from Vanguard or Fidelity or Schwab. You can implement exactly the allocation strategy you want. There is one exception. If your old employer's plan has access to institutional share classes with lower expense ratios than you can get in an IRA, it might make sense to leave the money there. Some large company plans have expense ratios that are essentially zero. You cannot beat that in an IRA, but for most people, the flexibility and control of an IRA outweighs any small fee advantage of the employer plan. And consolidating all your old 401ks into a single IRA makes managing your retirement savings much simpler. Let me give you a concrete example of how much these mistakes can cost you. Imagine two investors who both start at age 25 with zero savings. They both earn $75,000 per year and get 3% raises annually. They both contribute 10% of their salary to their 401k. They both retire at 65. Investor follows conventional wisdom. She invests in a target date fund that starts at 90% stocks and glides to 50% stocks by retirement. The fund charges 0.5% in fees. She checks her balance weekly and occasionally moves to cash during scary times, costing her about 1% in annual returns from bad timing. She never increases her contribution rate beyond 10%. Investor B follows my advice. He invests in a single low-cost S&P 500 index fund with 0.03% fees. He maintains 80% stocks throughout his career. He checks his balance once a year and never panics during downturns. He increases his contribution rate by 1 percentage point every time he gets a raise, ending at 25%. Let us assume stocks return 8% per year on average and bonds return 4%. After 40 years, Investor A has approximately $2.1 million. Not bad. She can probably have a reasonable retirement after 40 years. Investor B has approximately $5.3 million, more than double. He can have a very comfortable retirement with money to spare. The difference is not because Investor B was smarter or luckier. It is because he avoided the common mistakes. Lower fees, higher stock allocation, no panic selling, increasing contributions. These simple changes more than doubled his retirement wealth. This is not theoretical. This is how real wealth building works. The difference between getting it right and getting it wrong is measured in millions of dollars over a career. And most people are getting it wrong because they are following flawed conventional wisdom. I have tried to give you a roadmap for getting it right. Reduce your bond allocation, simplify your equity holdings, maximize your contributions, keep your fees low. Do not panic during downturns. Take advantage of the Roth option if it makes sense. Increase your savings rate as your income grows. None of this is complicated. None of it requires sophisticated financial knowledge. It just requires the willingness to question conventional wisdom and make decisions based on logic rather than fear. Your retirement is too important to outsource to a target date fund designed by people whose primary goal is avoiding lawsuits. Take control, make thoughtful decisions, and give yourself the retirement you deserve. The conventional wisdom is wrong. Now you know what is right. The rest is up to you.